Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Anisha Gupta and with me is Nigel D'Souza bringing you your daily dose of commodities, cryptos and currencies. But what do we have today, Nigel?
Well, plenty going on in all the three big Cs. But for the timing, let's tell our viewers about what went on in the equity markets. And overnight on Wall Street, there was yet another record close for the S&P 500. The Nasdaq, too, notched up a fresh peak, closing with gains of around 0.4%. Well, the blue chip Dow closed with a gain of around 0.6%. The street is now hawk-eyed on the negotiations between the United States and its trading partners before that crucial July 9th deadline. The U.S. stock futures, well, they are trading with more or less a flattish to a mildly negative bias. Well, a quick check on Asia-Pacific as well. The trade out there is more or less mixed across markets. The Japanese Nikkei has shut shop lower by 1% or thereabouts after hitting over 11-month highs just yesterday. So it appears some kind of profit-taking has creeped into that particular market, while the Shanghai has closed with gains of around 0.4%. While back home, it's yet another muted day on the Lal Street, with the Nifty absolutely flat at this point of time, though it continues to hold above that 25,500-odd mark.
But take a look at the crude oil prices, and meanwhile, that continues its downward trend on fears of the OPEC Plus hiking output in the month of August, coupled with a broader concerns around the growth seems to be weighing onto the prices. If OPEC moves ahead with the hike of in the month of August as well, the supply for this year then will hit 1.78 million barrels per day. That's equivalent to more than 1.5% of the global oil demand. But currently, the tariffs and their impacts on global growth is capping gains for prices. But it is the dollar index which continues to languish against major peers as Street monitors the current rhetoric around tariffs and trade deals. In fact, the dollar has clocked its worst first half since the second half of 1991. The dollar index has seen a decline of as much as 11%. Uncertainty surrounding trade deals with major countries and investors reducing their dollar exposure to historic level seems to be weighing onto the greenback lower. Mitul Kotecha now joins us. He's the head of forex and EM macro strategy Asia Barclays to the studio. Pardon me. Mitul, thank you so much for joining in. And dollar really seems to be making records of various sorts, not on the right direction though. But this 11% decline that we've seen in the first half of this year, how would you read this one? And would you believe further decline continuing for the dollar index for the second half of this year as well?
Yep. Hi. I mean, I think, look, the reality is that dollar has, as you said, struggled in the first half. I think there has been a number of concerns, whether it's to do with the unpredictability of policy in the US, whether it's to do with concerns about diversification away from US assets and increased hedging of US asset exposure as well, which is something that we've been focusing on greatly more recently. But I think this plus the tariff impact has also added to concerns whether the growth picture in the US is deteriorating, US exceptionalism, the list goes on. I think what we would say is that in the near term, that pressure is likely to be sustained.
Mm.
But further out, we would argue that a lot is already in the price for the dollar and that it would take a lot more significant bad news for the dollar to continue to weaken in the several months ahead. So near term, it's very difficult to see the dollar rebounding. But again, I think we have to be careful here that so much is priced in, as you mentioned, an 11% decline in the first half of this year is already pretty significant. And US assets have bounced back. US growth is holding up quite well. Exceptionalism in terms of AI is still a strong story in the US. So it's still difficult to completely write the US dollar off in that respect.
All right. Hi, Mitul. Good to see you, Ben. So if you're looking at a level for the second half of the year, give and take, the economic backdrop, as well as some kind of Fed action, and in all probability, we get at least 2 rate cuts from the Fed in the second half. Where do you see the dollar headed in that backdrop? Do you think, we can test lower levels?
Well, I think there is certainly a risk of testing lower levels from here. And what we have seen is a dollar continuing to grind lower on almost on a daily basis. And I think the risk has been that even when you see news that's good for the US, it seems like the dollar is really not finding any legs in that environment. So I think the sentiment remains fairly bearish and positioning is still quite negative on the dollar as well. And it does seem as if some of the hedging activity for dollar assets is starting to pick up. And that probably weighs on the dollar dollar in the near term. But look, I think, as I said, as we go towards the end of the year, as we go into next year, we think that that could turn around. And for example, the Fed, as you said, the market's already pricing in around two cuts from the Fed. We think the Fed will only cut once this year, probably late this year. Again, a lot is already priced in. And as I mentioned, the US economy is holding up. The labor market is only gradually softening. US
Yeah.
consumer seems to be holding up well. So again, it's probably a case that dollar sees some stability or gradual rebound, but just not yet.
The dollar's decline has been a benefit to various other currencies, though. If you look at euro, that one is trading at a 4-year highs. Singapore dollar at a 10-year highs. Pound sterling at a 3-year highs. What does it give? And would you see these currencies continue to benefit going forward?
I think it's been quite beneficial generally for most currencies. And if we look at the euro, it's continued to move higher on the back of dollar weakness. Sterling as well, and I think, as you said, sterling has performed quite well due to that. Plus the fact that there has been some expectation of UK moving closer towards the EU, if not really moving back to a EU situation, but at least moving closer. And in Asia, Asia has got very significant net international investment positions, a lot of investment potential for repatriation, potential for diversification. And the likes of Singapore, with a huge current account surplus, will benefit in that environment. And that's why we've seen the likes of Singapore dollar. We've seen big rallies in the likes of Taiwan dollar, for instance. Korean won also has been a currency that's benefited. So across Asia, we are seeing currencies gain in that environment. The two underperformers have been more the rupee and the Chinese yuan, which generally tend not to benefit as much. But overall, it's really a case where the weak dollar has lifted most currencies in this environment.
Mitul, besides equity markets and all the moves we've seen in various other asset classes, President Trump continues to remain in the spotlight, right? Overnight now, he decided to write a handwritten note to Mr. Powell. And Mr. Powell will, be out of office in the next few months or so. But the street is also eyeing who's going to be the probable replacement. And President Trump believes he's got a more suitable candidate. What do you expect on that front? If a candidate is announced sooner rather than later? Do you think it could put some further pressure on the dollar?
I think that's right. I think the risk for the dollar from here is exactly that if we see President Trump announce an early candidacy for the Fed chair, it doesn't mean that Powell will suddenly step down, and he's still got until May next year, but it could start blurring the messaging from the Fed, right? I mean, clearly people then start talking about a shadow Fed, and then you could get potential criticism of Fed policy, and it does start to at least lessen the impact of the Fed. It means that, again, if people see this, investors see this as political interference, it could also be something that's negative for dollars. So it's something that we're watching out for, especially, as you said, if it happens sooner rather than later.
When should we be looking at the replacement, ideally, since he's going to be giving up office in May 2026?
Well, I mean, look, again, it's hard to say ideally. I mean, Trump has suggested it could happen very soon.
Yeah.
But in reality, it's probably something that markets will look for early next year. And of course, any candidate will have to be approved by the Senate. But again, it's probably going to be a relatively quick process. But doing it so many months in advance is what I think will certainly provoke some nervousness in markets.
The President Trump has been busy talking to Elon Musk as well on X, as we call it. Tariffs is one thing, geopolitics another, and what has been happening in US with where all of these conversations seems to be happening. Is that yet another thing that bothers you?
I think on that front, there's obviously been, focus on the fiscal side, right? And whether we're going to see this big, beautiful bill that's being currently debated in the Senate, whether that's going to be able to be signed into law by Independence Day, i.e. this Friday. It's unclear whether that is going to be the case. It seems to be the case that the Senate is making changes that could only increase the deficit, and then that will have to go back to the House for approval or set to reconciliation. But again, it may not be a quick passage. There is definitely factions in the Republican Party in the Senate that don't approve of the current measures in the bill. So this is, again, another layer of uncertainty on the market, right? It's tariffs. We've got July the 9th, which will be the day that we see the end of this pause, or the question is whether we see that extended. We've got the fiscal bill going through the Senate, so there's a number of uncertainties I think markets are waiting to see some clarity on before that investors can make some more significant decisions. Until then, I think there's a bit of treading water. Equity is still doing very well in this environment. Bonds also seem to be holding up quite well. But I think for the dollar, it seems to be bearing the brunt of pressure at this point in time.
Okay, all right, Mitul, give and take everything, the Indian economy is appearing to be in a little better shape, I think so. How are you reading that? And also the Indian rupee, people were fearing we're going to be at 90 by the middle of the calendar year. Thankfully, that didn't happen. It stabilized at around 85 odd. Where do you see that one going? Going by the kind of macro tailwinds that we have, the crude oil prices that are lower, growth expected to pick up as well.
And that's right. And look, India's economy is one of the better performers globally, and clearly has outperformed some expectations in that front. And look, the reality is, though, that even if India grows strongly, it doesn't necessarily move the needle for the global economy.
Yes.
The most big economies are still quite weak, including China, and we're going to see deceleration in the US in the months ahead. But from an Indian market perspective, the rupee should do reasonably well in the short term, in our view, and we don't see the risk of a big sell-off from here. We do see some depreciation in the months ahead, but I think very near term we probably see consolidation around these sort of levels. There is some signs of inflows picking back up again. There's, I guess, some focus on clarity around policy here, whether the RBI will be able to cut rates again, and markets are not pricing in any more rate cuts. We think there is a risk potentially, however, that we could see one more cut from the RBI. But from a fundamental story, look, the current account numbers held up really well in the last quarter. We're not too worried about the capital account picture. So it doesn't, and as you mentioned, oil prices have come off quite well. So it doesn't seem like there are big risks to the rupee from this current environment. The bigger risk maybe is the RBI recouping its reserves, buying dollars in that sense, and building reserves back up again may limit gains in the currency, even against a weak dollar backdrop.
Mr. Long, I'm going to push you for some numbers here because, forex guys that we've been speaking to tell us that euro is not too far away from 1.18, even 1.20 for that matter. Dollar index could slide to 94, 95, and then we'll see what happens in the next year. How are you looking at that? Also, since you mentioned that the Chinese yuan and the Indian rupee perhaps are the only couple of currencies which haven't really performed much on the higher side, how would you put a number or a range to all of this for the second half of this year?
Right. So I think starting with the euro, we actually think the euro is probably not going to move much higher from here. Our actual Q3 forecast for this year is around 117, and we're already breached that. So the view that we have is probably the momentum will start to fade in euro dollar. We're certainly at this moment, of course, if hedging activity picks up, we could see euro dollar touch 120, but it's not our forecast. As for the yuan, we expect dollar yuan to settle around 720 by end of Q3, perhaps 725 by end of this year. And again, for the rupee as well, we would probably see consolidation. 85, 50, around these sort of levels is kind of important, but we don't see a big depreciation. Probably, I would say around 2-ish% is our view, 2 to 3% in the next several months. So again, we do expect to see some depreciation of the rupee in the months ahead, but nothing too dramatic in this environment.
All right, Mitul, always good speaking to you. Thanks a lot for joining in and giving us your view on how do you see the currency space shape up and expectations as well with regard to the Fed. Looking forward to chatting up with you in the near future.
Thank you. Thank you.
It's time to slip into a short break. On the other side, we'll take the discussion forward. We have Redoglia of Matrix Global, who will be joining in on the road ahead for Crude. Welcome back. Well, let's focus on a discussion that Manisha had with Redoglia of Matrix Global on the road ahead for Crude. Let's listen in to what he had to say.
Thank you very much for having me. This goes back to something that's gone on for the past 3 to 4 years. OPEC Plus, which remember is a construct that is different than OPEC historically. OPEC Plus was started in 2016. It brought in other larger oil producers, particularly Russia. And the reason they did that was they saw the world looking forward and saying we need to make sure that we control the majority of of OPEC supply or crude supply. And the key factor to that is that oil. There was a fear that oil demand was going to peak, and so what OPEC Plus did since before the Ukraine war was to maintain a control on the marginal supply of barrels. And why that is important is that when you um, maintain the control on the marginal barrel, you tend to put the market into a thing called backwardation, where the forward price, where the prompt price is higher than the forward price, and they've been doing that now for the past almost 5 years. But what has been happening over time is that non-OPEC production has started to rise. Offshore Guyana, a large field with Exxon and the Guyana government, offshore Brazil, and equally as important is other OPEC members. UAE in particular has started to have has excess capacity that wants to get into the equation. Iraq, and now the question is going to be Iran. And so what OPEC Plus has been doing, and this has really been led by Saudi Arabia because they are the ones who've taken out marginal supply from the equation, they're going to start putting it back into the marketplace. And that's really what we're seeing. And I think it's been a number of years where they have been able to control the price, keep it in a $75 to $85 range. But now as non-OPEC supply comes on, as U.S. oil production starts to move towards 13 plus million barrels a day, they're realizing that they're losing market share. And so what they're starting to do is release barrels back into the marketplace. And that is what we're going to see, I believe, in this next OPEC meeting. They have telegraphed this over the past year, and now it's coming through what they said they were going to do, and they're doing it.
We haven't even spoken about the non-OPEC increase in production, Richard, but the street does believe that we could be looking at a surplus of 1 million barrels per day in this year and perhaps 1.5 million barrels per day in 2026. Are you looking at that kind of surplus going forward as well? And if yes, then what does it do to the prices?
It makes them go lower. I've said this since I've been on your show here over the last week and a half, is I thought what we've been experiencing is a lot of price hype. One of the things, remember, commodity markets chase money. The commodity markets are not just oil companies, it's money flows. And the money flows since Donald Trump came into office have been on the short side of the marketplace. What the Israeli Iran attack did was take all those positions out of the market, right? They were forced to short cover, and that was where the spike in price came from. They had another secondary cover when the U.S. attacked, but all those shorts are looking to come back into the marketplace. But remember, we're not out of the woods yet. There still is tension in the Middle East. And with tension comes volatility and uncertainty, and really an unwillingness to put on large positions, either long or short. And that's really what we're experiencing right now. We're finding a market that is, I don't want to say is balanced necessarily, but it is in a price range, $65, which I just was looking at a price chart I had here. $65. If you look back, if you take away the high of the Ukraine war, and you take away the low of the COVID collapse, $65 to $70 is almost the exact price going back almost 20 years in the middle. Right, we're right in the middle of where we've been.
Richard, interestingly that you talk about prices, and well, yes, 60 to 130, 147 is an all-time high that we saw in case of crude oil prices.
I was around for 147. I remember that. I remember that, and that was 2008.
Oh, yes.
That was caused by a significant increase in Chinese demand, and the market never really caught up to it. But what that caused was a significant increase in U.S. oil production. Ironically, the high of oil price in 2008 at 147 was the low in U.S. crude production at 5.5 million. Now U.S. crude production is 13.5 million. Yes.
Richard, so since we're talking about prices, let's put all of that in focus now. And as you said, $65 a barrel was 20 years ago. We've done 147 and we've done minus 37. So clearly the crude oil prices in the last one decade especially have given us a whole 360-degree vision, if you can say, in sense of crude prices there. From where we stand right now, as you said, is it going to be more about 65 to 75 rather than 75 to 85, with the fact that we're looking at higher production from OPEC, non-OPEC, U.S. crude production at record highs as well? Would you see more pressure going forward, not just in this year, but the years to come?
I tend to believe that we're looking at prices in the 75 to 55 range.
Okay.
I think as you move down towards the lower band of prices, you start to see some increase in demand. You start to see some issues on the economics of finding new drilling. And so I think the higher prices, while they could always show up as a function of um, some kind of world event, we're really seeing the world is able to produce the extra barrel. And technology, particularly horizontal drilling, um, we've experienced something that has allowed the market to find balance. And if you've noticed what happened in the prices over just this last 2 weeks, the instantaneous move. And I've said to one of your compatriots not too long ago that information technology is so quick, it's so fast, and it has the ability to understand what's happening almost instantaneously, that it takes away some of that forward volatility that we experienced even going back 10 years. That information technology was not so amazing it is now. And so, because we know where things are so rapidly, and are able to understand supply demand so quickly, it's remove some of the uncertainty of the forward market.
Sure. Richard, you've already given me a price view of 55 to 75 going forward. Do weigh in on a couple of other numbers as well. One, when do you see the crude oil demand peaking globally? We do understand that China perhaps could lead there first faster. That is one. And the second point really is about that if you're looking at a lower crude oil prices going forward, what does it do to the investment when it comes to the fuel energies then?
Both very good questions. I don't believe in peak oil demand.
Okay.
I learned years ago there was a thing called peak oil supply, and I tend to believe that the climate change approach to the market is misplaced. If you just saw what happened in the UK yesterday, they had multi-billion, 20, $30 billion solar panels that were going to be built in the Sahara Desert and shipped power to the UK. That all stopped and completely. I think what we're seeing in the U.S. In the new budget proposal is a cutback on the renewable um, sector as much as it has to do with subsidies. I think that what we're seeing out of China is a new coal plant built every single day, or excuse me, once a week a new coal plant is being built. And so I tend to believe that what we've experienced over the last 10 years on the renewable sector, while we'll continue to see investments in solar and there'll be some new things that happen, I think the idea that oil demand is going to peak is, I don't want to say far-fetched, but let me just give you some numbers here. And this is, I think, interesting to look at. Oil demand in the last since 2010, oil demand was 87 million. In 2016, it was 95 million. In 2021, it was 96 million. Last year, it was 103 million, and this year it's supposed to be 105 million. So, what's peak oil demand mean to you? Is it a slowing of the increase, or is it
Plateauing?
actually a peak? Well, it's not flattening. It's not the numbers I just raised were not flattening. And I tend to believe that when you see increases in demand out of the Far East, China demand, true, can start to see it's been the largest modifier. But you tell me, in my mind, India is the engine of growth.
Yeah.
And the question is going to be, does your government decide to go down a path of renewables, which tend to be more expensive than, say, diesel fuels or natural gas or LNG and petrochemicals? If it doesn't, then I would expect to see India be where you want to look to as far as and how it relates to demand, oil, kind of total oil demand. I think your current oil demand is about 5.5 million barrels.
Yep.
What's it going to be next year? We'll see.